Welcome to Echo 311, Study Session 1, Definition and Scopes of Accounting. Introduction. In day-to-day management of a business, there is need to maintain records and give report at the end of the period's financial operations and as a means of stewardship evaluation, learning outcomes. After you have studied this session, you should be able to 1. Define accounting. 2. Differentiate between bookkeeping and accounting. 3. State the benefits of and the needs for accounting information. 4. Explain types of accounting information. 5. Explain users of financial information. 6. Explain short historical background of accounting. And 7. Identify and explain accounting assumptions, that is, concepts and conventions. Definition and scope of accounting. Accounting is the recording, measuring, interpreting, and communication of economic activities of an entity in a monetary term, which enables the interest parties to pass judgment and make decisions. It is a means of giving report about a concluded or historical event or circumstances. Individuals and business firms keep records of their transactions engaged with other individuals and business firms. The art of keeping records is termed bookkeeping and accounting, differentiating between bookkeeping and accounting. One, bookkeeping is a task carried out by a bookkeeper, while accounting is a professional task carried out by an accountant. 2. Bookkeeping initiates recording phase of accounting process, while accounting ends the result or product of bookkeeping process. 3. Bookkeeping is an integral part of accounting, while accounting incorporates bookkeeping. 4. Bookkeeping deals with day-to-day recording of transactions, while accounting is concerned with the preparation of the financial information. 5. Bookkeeping does not require much of accounting skills, while accounting requires application of professional skills. 6. Bookkeeping is very narrow in scope, while accounting is wider in scope than bookkeeping. 7. The minimum qualification requirement for bookkeeping is O-level, while the minimum qualification requirement for accounting is OND. Benefits and needs of accounting information. Number 1, it helps to determine the profitability of a business. 2, it provides information for decision making. 3, it provides permanent records of transactions relating to an entity. 4, it helps to evaluate the financial position of a business. 5, it helps in carrying out strategic plans that will affect the entity. 6, it helps in ascertaining the total turnover and expenses. And 7, it is helpful in the assessment of tax liabilities of a business. Accounting information. Accounting information is obtained from accounting records and assists in assessing the past and present economic activities of a firm and serves as a guide for future policy. The types of accounting information are: 1. Financial accounting information, which provides information about the financial operations and position of an entity at the end of the period relating to its historical events. 2. Cost accounting information. It provides information about the associated cost to be incurred on products and services in the current or future period. 3. Management accounting information. It helps to provide information for evaluating management performance and to help in planning and decision making. Parties or users interested in accounting information. Parties or users interested in accounting information are those parties that need financial information of an entity in order to pass informed judgment and make reliable decisions. Users need accounting information for different reasons depending on individual stakes in such businesses, firms, or organizations. Users of accounting information are 1. Internal users. 2. External users. Internal users include the management, the employees, the labor union, all within the organization. External users are the shareholders, the government, the customers, the banks, competitors, tax authority, members of the public, suppliers of the business. Interested parties and decisions to be made. 1. Shareholders. Their decisions include assessing business progress and determining dividend. Number 2. Management. Their decision is for planning and decision making. 3. Employees. Their decisions are to make collective bargaining, to agitate for salary increase, to evaluate job security. Number 4. Government. Their decisions are to regulate the business activities, to determine business compliance to law. Number 5. Banks. Their decisions are to assess the liquidity level of a business, to know if the business will be able to pay its debt. Number 6. Customers. Their decisions are to know if the business will still be in operation, to determine business regular supply. Number 7. Tax authority. Decisions are to determine the taxable profit of a business, to calculate the taxability of the business. Historical background of accounting. Accounting could be said to have started among the ancient Babylon, Assyria, and Sumeria, which dated back more than 7,000 years. The mode of keeping records then involved making marks on walls or stones. It is a primitive method of accounting. The early historical stage of accounting proceeded to meaningful sense with the introduction of double entry bookkeeping system, popularly known as the Italian method. It was believed that Fra Luca Bacioli invented the use of double entry system in 1494. He was regarded as the father of accounting. In 1605, a Dutchman, Simeon Stevie, introduced the use of profit and loss account. Modern accounting systems started during the Industrial Revolution. Need for standard accounting prompted the establishment of several professional accounting bodies, which include ICA of Scotland in 1854, which is the first accounting organization in the world. Then we have ICA England and Wales, 1880, etc. Accounting assumptions and conventions. Accounting concepts are the broad basic assumptions guiding the preparation and presentation of financial statement of an entity. The 8 accounting assumptions could be represented by GEM PhD. G stands for going concern. It assumes that a business will continue to exist and operate for an indefinitely long period of time. E stands for entity. Accounting information is prepared from the point of view of the organization as an entity with affairs separate from that of its owners. R stands for realization concept. Revenue is recognized and generated as far as goods is transferred to the customer, even if cash has not been received. M stands for matching concept. Revenue generated in a given period must only be matched with the expenses incurred to generate such revenue. The second M stands for money measurement. A, accounting information is assumed to contain only facts that can be expressed in monetary terms. P stands for periodicity. Businesses should prepare the financial statement or records relating to their economic activities on annual basis or otherwise. H stands for historical cost. Only the cost price, that is the purchase price of assets, services, can be used as measurement of value, which should be included in the financial statement. D stands for dual aspect. All items of transaction must be recorded twice by reflecting the given aspect, that is credit entry, and the receiving aspect, that is debit entry. Accounting convention. Accounting conventions are regarded as the acceptable practices concerned in the application of accounting concepts. The 6 accounting conventions could be represented by POF SMC. P stands for prudence. It is a practice which states that businesses should not overstate their profit and possible losses should be provided for. This is also known as conservatism. O stands for objectivity. Accounting information should be a record of facts that can be verified independently and not subject to personal opinion. F stands for fairness. This is a practice which stipulates that accounting information should be free from bias by not favoring one party of the users at the expense of the others. S stands for substance over form. It is an accounting practice in which items of transactions are treated from the accounting view rather than from the legal view. M stands for materiality. It is a practice which stipulates that items of transactions with insignificant magnitude may be ignored since they will not distort the information reviewed by the account. C stands for consistency. Business should try to be consistent in the use of a particular method in treating items of assets, income, assets, and liability before a change could be considered. Summary. For this session, you have learned the meaning of accounting, historical background of accounting, and certain accounting information. You have also learned the various uses of accounting information and also the basic assumption in accounting, that is, accounting concepts and conventions. This is the end of study session 1. Okay. Thanks for listening.